Good morning, everybody. Thank you so much for joining me today. It's February 26th. Before you know it, it's going to be March. On Friday, it's going to be March, and we'll start another year. Just noticed that I got something growing here. Anyways, what are we going to talk about today? Let's talk about the markets again. The weather, there isn't much to say here in Long Island. It's kind of cloudy. Nothing exciting. But it's been a really mild winter, so that's been a good thing. Max isn't here today, and not so far. He might show up, but when my wife is home, I think he likes her more than he likes me, so he hangs out in her office. So that's where he is. And again, for some of you well-wishers, Max wasn't feeling too good about a week ago, and now he's fine. So let's focus on the markets here. In the quick takes last night, I went through this idea that the market is, some of the critics of the market said it's just too narrow. And they focused on the mega cap 8. Some people call them the Magnificent 7. Again, I like movies, so I got Netflix in there. And so the mega cap 8 currently account for something like 28% of the S&P 500 market cap, and they've had some really great performance. But as I pointed out in the quick takes, even within the mega cap 8, there's some narrowing of the market. We've had two stocks, NVIDIA and Meta, with triple-digit increases since the beginning of the bull market. Then there's another 5 that have had double-digit increases, and one that's had a negative double-digit decline. That's Tesla. But the outstanding two companies have been NVIDIA and Meta within the mega cap 8. So I guess you could argue that even within the mega cap 8, there's been some narrowing of breadth. But the big story, I think, is that a lot of people, including ourselves, do look at all these various indicators of market breadth. And one of them has been the ratio of the S&P 500 equal weighted to the S&P 500 market weighted indexes. And that's dropped significantly since the beginning of the bull market. So the equal weighted hasn't performed as well as the market cap weighted. And the market cap weighted obviously is given a 28% weight currently within the S&P 500 to the mega cap 8. So the conclusion is, therefore, the market's breadth has been narrowing, and that's not necessarily a healthy sign. What we did is we took a look at the 137 industries that we cover in the S&P 500. We don't cover them as analysts, but we're monitoring their price indexes, and we're looking at their forward earnings, forward revenues, forward profit margins. Anyway, so in one table, we showed their performance in terms of their stock price indexes since October 12th, 2022, which is the beginning of the bull market. And of the 137, 8 of them are clearly the mega cap 8. I'm pretty sure each one of them is in its own industry. I mean, they're all in 3 sectors. They're in telecom and the communications services is now the way it's called. It's in information technology and in consumer discretionary. But as within industries, of the 137 industries, they are in 8 industries. Well, we had then a look to see, well, how many industries are up 20% or more since the beginning of the bull market? And the answer is 87. So 137 industries that we have on the table, 87 of them are up 20% or more. So it's not that the market really has been unhealthy in terms of its breadth. It's just that some of the mega cap 8, particularly NVIDIA and Meta, have done so extraordinarily well that they've kind of left everybody else in the dust. But everybody else has actually been doing all right, or at least 87 of the 137 are up 20% or more. So it's been actually a fairly broad market. Just some of the big cap stocks have outperformed to such an extent that it's brought down that ratio that some people look at as a breadth measure. And I know there's other measures of breadth, but the point of the matter is that there's been lots of stocks that have done very well since, and industries that have done very well since October 12th, 2022. Well, this week I focused on the idea that of the roaring 2020s again. But what I've kind of mixed it up a little bit by saying, well, the 1990s was kind of like the roaring 1920s. So maybe it was the roaring 1990s when we kind of look back with the benefit of hindsight. And so that's what I did. I ran a lot of charts that highlighted the 1990s and came to the conclusion that, yeah, the 1990s was a roaring decade like the 1920s, and for similar kinds of reasons. Well, I mean, both started out with recessions, both the 1920s and the 1990s. But also both had technological innovations that boosted productivity, brought unit labor costs down, and kept inflation low while real GDP grew faster than had been anticipated. At the beginning of the 1920s, everybody was pretty depressed. A few years before that, it was World War I. Then a year or so before that, before the 1920s, it was the Spanish flu. Then in 1920, they had what was called a depression. They didn't have the word recession back then. And now in the 1990s, we started out with an S&L crisis that caused a modest, shallow recession in 1990. And then the first half of the 1990s was kind of lackluster, but inflation was relatively low. And then the second half of the 90s is when we really got the action going that was reminiscent of the 1920s. So let's have a look at the 1990s. Let's go back in time a little bit. And instead of continuing to talk about the 1920s, let's compare the 1990s to the current decade. So let's do that. That should be fun. You got to say one thing about our business. It is fun. It is interesting. Never a dull day. And as I've said before, sometimes I wish we had a dull day or two. Maybe today's a little bit dull. The market's starting out kind of quiet, so that's good for a change. Let me put on my reading glasses here. So here's the S&P 500. It's been an extraordinary melt-up situation, really, since this 10% correction that we had last year. The bull market's up over 40% since it bottomed back here in October 12th of 2022. This was October 27th of 2023. And, it was sort of, even at this point, there were people kind of questioning whether this was actually a bull market. I don't think there's any question about that anymore now that we're at record highs and we've seen this explosive move to the upside. That move has been led by technology companies, by communication services companies, and obviously the NASDAQ's done very well. So particularly the NASDAQ 100, the so-called QQQ, all-time record high. So that's looking good. When you take a ratio of the NASDAQ 100 to the S&P 500, you can see that the NASDAQ 100 has been a pretty good performer relative to the S&P 500 for quite some time. But our point here is to kind of compare the 1990s to the current situation, and they're really not that comparable in terms of this chart. I mean, we clearly could see in this chart how the NASDAQ 100 was increasingly outperforming the S&P 500, and then just boom, it just exploded to the upside. I think this was LTCM, and then when that problem was solved, the market just went on an absolute joyride to the upside here. So led by the technology companies, especially the big cap technology companies. And then it all kind of came unglued. Part of this surge was Y2K companies spending on avoiding that problem, and it worked. That there wasn't a Y2K problem after all. I thought there might be, but it turned out that the Y2K problem was really that companies spent so much on technology using Y2K as an excuse to do so, that when the clock rolled over to 2000, spending just took a dive, especially telecom spending, maybe some computer and software spending. And so they kind of hit a wall, and you could see that in the performance of the Nasdaq 100 relative to the S&P 500. But then the outperformance of the Nasdaq 100 resumed here once things settled down after, let's say, 2000. Well, I guess really after the great financial crisis, you really saw the Nasdaq 100 outperform. Then this was the pandemic situation. Then we had this recession last year where and with interest rates going up, so the Nasdaq 100 didn't do so well relative to the S&P, and now they're doing very well again. Who knows? I mean, we're clearly above anything we had back here. But let's look at some other charts for comparisons of the 1990s and the current decade. This is another chart that I've looked at, shown you recently, just for fun. This shows you Cisco going straight up, going from basically close to zero to $80 a share. And then it took a dive all the way back down to $8 a share. This is NVIDIA. I'm not trying to imply here that NVIDIA is going to take that kind of dive, but certainly it's acting much the way Cisco did on the way up. And Cisco was sort of the premier internet play. And the internet obviously survived all this, and yet Cisco nevertheless took some drubbing here. There was some seller financing going on by a lot of telecom companies. I don't know if Cisco resorted to that, but when seller financing kind of dried up, or everybody had their telecom equipment for the internet all set, the business really dried up, but the internet flourished, of course. This is over here. We actually set up our first. I think that we had the first website on Wall Street, or at least among economists. 1995, I went to Barnes and Noble and got myself a book on HTML programming. It was pretty easy to do, and set up a website back then. And here we are doing Zooming, doing these Zoom calls. So here's, speaking of Zooming, this is what NVIDIA's done, divided by 10, just to put them on the same scale. And you can see that we're kind of replicating so far what Cisco has done. Just a little bit, history doesn't repeat itself, but it does rhyme, and something to consider. So more on the 1990s, and to do that, we're putting some shades here from the beginning of 1990 to the end of 1999. And this is real GDP growth on a trend basis. This is a moving average of real GDP growth is 3.1%. And you can see that during the 1990s, we had this recession. It was fairly short and relatively mild. And then we bounced back up to kind of the historical average growth rate of real GDP. But you can see that in the second half of the year, we were actually exceeding that. And the growth rate was more like 4.5% on a year-over-year basis. Where are we now? Well, we had this lockdown recession. Then we had the rapid recovery. Then things have slowed down a bit. We had the weakness in 2022 and early 2023. So things slowed down. But now we're back to 3.1%. Where do we go from here? We think we're going to stay either at 3.1% or go higher. In other words, we're either kind of going to mimic the historical average or do better. And we think we're going to do better, kind of like what happened back here. And what happened back here is we had a significant rebound in productivity, which boosted real GDP. And that's our thinking, that could happen again. So here's the productivity story, again, with the gray shades for beginning of the decade, the end of the decade. And we started, it's a volatile series for sure. Putting a little gray shade on the thing kind of helps us focus on what we're interested in here. And you can see you had this bounce in productivity, quite significant. Then it kind of bounced the other way. And then we started to see a fairly consistent increasing trend in the growth rate of productivity to the point that we got to 4% by the end of the decade. And that was a big contributor to boosting real GDP in the second half of the year. Because real GDP growth from a supply side is the growth rate in the labor force plus the growth rate in productivity. So where are we now? Well, it's kind of similar kind of situation, right? This big bounce in productivity, then a big drop, Now, all of this was pandemic related, so pay no attention to any of this. It was a unique experience. Hopefully, not one that we're going to repeat anytime soon or ever again. But now you can see the productivity growth, which historically has averaged 2.0%, is slightly above that average at 2.7%. And we think, back here, that the technology, this was kind of the first round of the technology revolution. It was the PC, it was Windows, Wintel, and all that. Now with the cloud, with maybe with NVIDIA, AI, but certainly with automation and robotics, and with technology being so affordable, we think that the growth rate of productivity is probably going to exceed this 2.7% and be 3%, maybe 3.5%, maybe 4.5%. I don't want to get too excited here, but it's conceivable. It's happened before, and I don't see any reason why it couldn't happen again. In the sense that we've got labor shortages, and we need to address those labor shortages by pumping up productivity. Before we get there, let's look at inflation during the 1990s. And you can see that inflation started out quite high. This is the headline CPI. So it was around 6%, and it moderated down to around 3%. And you can see that the underlying inflation rate is unit labor costs. That's this blue line. And unit labor cost is hourly compensation divided by productivity. So productivity is one of the two variables that is the driver of unit labor costs. Unit labor costs, in turn, dominate, I think, the underlying inflation rate. And as you can see, the CPI is quite closely related to unit labor costs. And unit labor cost inflation actually dropped down to zero by the middle of the 1990s. And then it picked up some, but it stayed relatively low and kept inflation down. Where are we now? I think we're heading back down to 2%. I think inflation is going to be lower than it was back here, but we're kind of already back to the 1990s kind of environment on inflation. We'll see why that's relevant in a second when we talk about the Fed and real interest rates. But here's the 1990s again for the unemployment rate. Unemployment rate went up during the recession that started the decade, but then the economy grew at a faster pace. The unemployment rate came down all the way down to 4%. Look at the current situation. Ignore all this. This is pandemic related. Look at this. You see that the unemployment rate before the pandemic was already below 4%. And now, for the past 25 months, including February, based on initial unemployment claims, I think it's pretty clear that the unemployment rate is going to remain under 4%. So based on all that, I think we've got 25 months here of persistently low unemployment. Labor market is tight. And if you look at the same chart with the unemployment rate again here in red versus the trend cycle growth in productivity, it's a 20% change at an annual rate. So you can see that there's not a perfect, but there is an inverse correlation between the unemployment rate and productivity. Why? Well, it kind of makes sense. If the labor market's very tight, companies in that environment are probably doing pretty well. GDP is doing well, sales are doing well. But it's frustrating that you can't find the workers you need to, cash in on all that. So work overtime to increase productivity. And that's what we typically see when the labor market is tight. And this is chronically tight. I don't think it's going to change, certainly not the skilled labor. Hard to say what happens with all the migrants coming in, how that all settles down. Much will depend perhaps on the politics. So at this point, I'm not factoring that into thinking about where the economy is going, though clearly a lot of those migrants could be very helpful in relieving labor shortages in the services sector. So we'll see how that plays out, and we'll be watching it. But so where are we with the Fed? So everybody's been expecting, the market's been expecting that the Fed's going to be pausing, not going to be raising rates anymore, and that this year the Fed funds rate will be cut by 5, 6, 7 times, or will be cut 5, 6, 7 times. That was the thought at the beginning of the year. And the Fed kept pushing against that, and the data started to confirm that the Fed was right in trying to push back against the idea that they're going to cut rates a lot. They've been talking about 3 rate cuts for this year during last year. And now our thinking is 2 or 3, maybe 3, but 2, maybe the second half of the year with maybe in capital letters, because there was a precedent here in the 1990s where that there was a recession, inflation came down, the Fed was once again lowering interest rates. Then the economy started to really pick up. We saw that inflation came back to something like 3%, but the Fed raised rates and then it paused. And there's a lot of volatility back here. But the bottom line of it was that interest rates, basically for the second half of the 1990s, remained flat. The Fed funds rate remained flat. So that's a scenario to consider as a possibility. I don't think the Fed's going to be raising rates, but the economy continues to do well based on productivity. Inflation continues to moderate. There's no particular reason for the Fed to lower interest rates if, in fact, the economy is hanging in there and they conclude that because of a productivity rebound, that maybe the real federal funds rate is higher now than they thought. So let's look at that. This is the real federal funds rate, which, just for the record, I think is a bizarre concept, but people do talk about the Fed funds rate minus the CPI inflation rate. Fed funds rate is an overnight rate. The CPI inflation rate is a year-over-year percent change. And I don't know that too many people make their decisions on the real Fed funds rate. Nobody says, tell me what the real Fed funds rate in order to make a decision on what I'm going to do with my business. Maybe real bond yields matter, but real Fed funds rate, not so much. But they can obviously have an impact on the bond market. So there is some credence to the idea that the real Fed funds rate matters. And one of the main reasons it matters is because the Fed thinks it matters, and they keep talking about the Fed funds rate relative to the neutral real rate. But as you can see, in terms of what you can touch and feel and measure, you can see that the average real rate has been 1%, which doesn't really mean much because it's been very volatile all over the place, which also suggests that the neutral rate might be also quite volatile. But the real Fed funds rate here is 2.24%. That's the number you're seeing here. But again, look at the 1990s. It came down below the average. And then for quite some time there, it was running around between 2 and 4%. So there's no particular reason. So in other words, if inflation comes down and that the Fed funds rate goes up to 3-4%, we've lived with that before. Economy did just fine back here. And this was a period when productivity was strong, real GDP was strong, and inflation was relatively moderate. This is the bond yield. The bond yield, inflation adjusted, makes more sense. And back here, you can see that it kind of fluctuated between 2 and 4%. And now, if you look at the real bond yield, it's 1%. The TIPS yield, which correlates pretty well with the actual real bond yield, is at 2%. So again, even if inflation comes down, there's no particular reason why the bond yield couldn't stay around 4%. If inflation comes down to 2%, bond yield is at 4%, that's a 2% real rate. And we certainly lived with that, and the economy functioned just fine. And so this is consistent with my view that I've discussed with you before, that sure, the Fed's raised interest rates 525 basis points during this tightening move during 2022 and 2023. But they've also normalized. It's up 525 basis points from zero, and zero was the abnormality, not 5.25%. As we saw before, this is the rate here, and you can see that this is 5 to 6. So 5.5% is exactly where we were during the second half of the 1990s. That's kind of normal for the economy, in my humble opinion here. Because of all that's been going on, we've had a bull market since October of 2022. Let's go back to the 1990s, and these are various measures of the value of the stock market. This is the total value based on Fed data that includes all stocks traded in the United States. This is the Wilshire, and this is the S&P 500. So it's the value in trillions of dollars of the market. And as you can see, there was a remarkable increase in the value of the market during the 1990s. We may just be starting something like that. The important thing is that we now have a positive wealth effect. And a positive wealth effect is another reason to believe that consumer spending is going to continue, that'll in turn help to stimulate GDP. And keep in mind that a lot of this equity wealth is owned by baby boomers who are retiring. And so they're in a pretty good financial position, many of them, with $75 trillion in net worth held by baby boom households. The overall economy's households have $155 trillion. So we'll be monitoring the situation for a melt up. I mean, that was the 1920s had a melt up followed by a meltdown. The 1990s had a melt up followed by a meltdown. So I'm rooting for a civilized bull market. Melt ups are great. You can make a lot of money in a short period of time, but you got to know when to get out at the top. It's not necessarily always that easy. And it's annoying because then you got to take some gains, and you can't let the magic of compound dividends work for you. But clearly it's conceivable, especially now that we've got all this excitement about artificial intelligence, that could create some a melt-up situation. So we're watching things like the long-term earnings growth, analyst consensus expectations. The market goes up and analysts are embarrassed that their price target is too low. Guess what? Some of them are going to start rethinking about what the market's seeing that they didn't see, and they start raise their expectations for earnings growth. And you can see that this is what long-term earnings growth of analyst consensus did during the melt-up of the 1990s. Then we had another melt-up here going into the pandemic, where again earnings expectations really got boosted. There was the Trump tax cuts on margins, and so margins got boosted, I should say. Then we had this situation right before this was sort of the pandemic-related bull market, and all the excitement there again was focused on the mega cap 8 and how much these companies could grow their earnings, and that all kind of fizzled away very quickly here. These are long-term earnings growth expectations. You can really see that there's solid belief in these numbers by the analysts. But anyways, once again, they're getting excited, but they're still below some of these peaks in the past. So this is one of our melt-up indicators. This is the LTEG, long-term earnings growth expectations, that analysts have that cover the mega cap 8. And as you can see, that they went from being, it's only going to be 15%, to something in the order of 40%. Finally, what if it's not the 1920s? What if it's not the 1990s? What if it's not the roaring 2020s? Well, it could still be the 1970s, and much will depend, I think, on the geopolitics of the Middle East. Things really get out of hand in the Middle East and the price of oil starts to soar. We'll be worrying about the Twin Peaks 1970 scenario. That's low probability in our mind, but we're watching the price of oil. So that kind of covers my presentation here. Let me answer some of the questions that we got. Okay, when and how do you think we will get to a normal sloping yield curve if the Fed stays higher for longer as you anticipate? I'm going to have to think about that a little while. I don't know why I haven't given it more thought, but I guess it implies that it will remain inverted or flat. It doesn't suggest that it's going to be ascending anytime soon, because if the Fed's, let's say, does wind up keeping the Fed funds rate at 5 to 5.5% through the end of the year, what's the 10-year going to do? There is a scenario, which isn't a pretty one, in which we get these large auctions, and they don't go so well after all, since investors are coming around to thinking that maybe short-term rates are going to stay higher for longer. And so what's the rush to buy the bonds? And then I guess you could have the bond yield continue to go up. But with inflation coming down, with productivity kicking in, with so much wealth out there, I'm still thinking 4%, plus minus 25. Maybe I have to make it 50 basis points the way things are going. But I think 4% is a fairly reasonable forecast for where the bonds are going to be. But that still implies an inversion of the yield curve. So I'm not quite. Let me think about that some more. Michael, whether we're in the 1920s or the 1990s, what inning do you think we're in? Well, with regards to the stock market, with regard to the economy, the last recession was back in the pandemic lockdowns, and it only lasted two quarters. But the aftershocks meant that it was the labor market was pretty depressed for quite some time. I don't know. I mean, I do know. My official forecast is that the S&P 500 is going to go to 5,400 by the end of the year, or next week, or next month. We'll see. I'm not too good at timing these things, but I think it's going to go still higher. And then I'm thinking that next year we'll be going up to 6,000, and then in 2026. 6,500, which isn't a big increase, obviously, from 6,000. But the basic message is the bull market lives and carries on, continues to move ahead right through 2026. So time-wise, we still got some time, in my opinion. Cactus, if we get a meltdown, you think it will be a substantial one, more like in 2000 tech bubble and or 1920 meltdown, or a more modest meltdown where dip is bought as AI story is more real and sustainable than previous bubbles potentially? The answer to your question is yes. I do think that this technology technology-led productivity boom has a lot more going for it than any previous productivity boom. The previous productivity booms way back when were focused on increasing the productivity of brawn, of muscle, of people working hard. So the manufacturing came up with the automated line, manufacturing line, and that relieved a lot of the brawn required to make things. Now I think it's both brawn and brain. And I think it's the technology revolution that started in the 1990s has evolved with the cloud, with robotics, automation, with AI as still sort of potential catalyst for still more productivity. All that suggests to me that the productivity rebound could be much stronger, much more sustainable. In which case, whatever technical meltdown we get in response to the market getting too far ahead of the fundamentals probably isn't going to be all that severe. William, your 1990s interest rate comparison, how much impact does today's Fed debt compared to the 1990s make? Yeah, I think that's an important difference, obviously. So it's I think you're basically saying it's nice to look at all the similarities, but the differences should also be considered, and I will do that. But clearly, the issue with regards to the debt is a significant one. It is different this time in terms of just how large it is and how interest expense is mounting. Of course, if the economy does grow better than expected, that would help to offset some of that concern, because the debt to GDP ratio then wouldn't be going up as fast. But for now, I'll say what I've said in the past. I'll worry a lot more about the debt when the bond market worries about it. So I was worried about it last summer through the early fall. But right now, the bond market seems to be handling the debt reasonably well. So with that relatively optimistic viewpoint, let's meet again next week. Thanks for joining me today, and have a good week. All the best.